Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Broadcom stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 505 billion market cap. They're trading at $1,078 a share, and they have 468 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They're really consistent and steady growth, 11.6 billion up to 17.6 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also grows a lot, from 3 billion way up to 14 billion. Revenue is the sales for the company, and that also grows each year from 24 billion to 36 billion. Really impressive financials with this company. We estimated 4 years of future free cash flows. We also estimated the terminal value. It's all cash flows past year 4, that's 501 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $445 billion. We divide that by 468 million shares. And we get a calculated stock price of $9.51. They're trading at $1,078, so they're trading at a 13% premium. It's a sell according to the model. So it seems like a lot of these semiconductor stocks are overvalued, but they're putting up really impressive numbers. So as long as the stock keeps going up, it's okay to hold. But there might be a pullback, and you don't want to own the stock during a pullback because a lot of people sell out of fear. Usually it rebounds, but sometimes the rebound could take a few months or a few years. So people get antsy and sell prematurely. There are 61 companies in the same industry as Broadcom, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, 450 million. It is higher than the median, lower than the average. They're fabless, so they outsource a lot of the manufacturing to Taiwan Semiconductor and Intel. They're a bit leveraged. It looks like they have the worst debt-to-equity ratio of all these companies, 1.6. So for every dollar of equity, they have $1.60 of debt. They do pay a dividend of 1.7%, which is about the median. They generate the most free cash flow out of everybody, including NVIDIA. They rank third in market cap, a little behind Taiwan Semiconductor, a lot behind NVIDIA. Their price multiples are okay. Their price to book is a lot worse than the median average. Their PE is between the median and average. They have a good price to free cash flow, better than the median, a lot better than the average. Their price to sales is a lot worse than the median and average. They generate lots of revenue, 36 billion. Taiwan is number 1 at 67 billion. Their 5-year annual revenue growth rate is 11%, higher than the median and average, a lot lower than NVIDIA and AMD. They completed their 2023 fiscal year. Their fiscal year ended 10/29, so this is their 10K. Let's take a look at their income statement. They show us 2021, 2022, and 2023. Revenue of 36 billion. They give a breakdown, 28 billion in products, 8 billion in subscriptions and services. Let's see if they give a different breakdown of their revenue. Of the 36 billion of revenue, 8 billion is in the Americas, 23 billion in APAC, and 3.6 billion in EMEA. Most of their revenue in Americas is subscriptions and services. Those are much higher margin than products. Here's another breakdown of their revenue. Of the 36 billion, 28 billion is semiconductor solutions, 7.6 billion is infrastructure software. Let's take a look at this income statement. It gives you percentages. Here's their revenue, 36 billion. Expenses related to subscriptions and services, 630 million. You could just see how high the margins are, because a majority of the 7.9 billion is profit, only 630 million of expenses. With products, it's 28 billion of revenue, 8.6 billion of expenses. So their cost of revenue is 11 billion. So their expenses have gone down. Last year, their expenses were 33% of their revenue. Now they're 31%, which means their margins go up. Their gross profit is 24.7 billion. Gross profit is revenue minus cost of revenue. So their gross margins are 69%. Last year, 67%. R&D is pretty much flat as a percent of revenue, 15%. It's 5.3 billion. Last year, 4.9 billion. SG&A, 1.6 billion. Amortization of acquisition-related intangible assets, 1.4 billion. Because when they acquire another company, they amortize the intangibles, like patents and trademarks. So total operating expenses, 8.5 billion. Their operating income $16 billion. Their operating margin is $16 billion over $35 billion, 45%, which is higher than last year. Last year was 43%. And to calculate the 43%, it's $14 billion over $33 billion. So you want to see a company grow its revenue, but equally as good as growing revenue is managing expenses. And this company is doing a good job at both. This is the full income statement. So below operating income is interest expense, how much interest they pay in their debt, $1.6 billion. Taxes of $1 billion, so net income of $14 billion. More than double 2021 of $6.7 billion. A strong EPS of $34 a share. $16.21, $27.22. They did lower their shares outstanding from 2021 to 2022, 410 million to 409 million, but they increased it to 415 million in 2023. But as long as their EPS is going up, that's the important part. Ideally, you like to see shares outstanding go down, but if they raise their shares outstanding, it's fine as long as they're raising their EPS. If they were raising their shares outstanding and their EPS was flat or going down, that wouldn't be so good. Let's look at the balance sheet. $21 billion of current assets. Current assets are assets that can be converted to cash within 1 year. So they usually consist of cash, accounts receivable, and inventory. Current liabilities of $7.4 billion, so their current ratio is well above 4. So they're a highly liquid organization. Total assets $73 billion, similar to last year. Goodwill is their biggest asset by far, $44 billion. They do lots of acquisitions, as you can see. Here's a breakdown of the $44 billion. $26 billion is from Semiconductor Solutions, so the acquisition of companies in Semiconductor Solutions, and $18 billion are companies in infrastructure software. They completed 3 acquisitions in 23 and 4 in 22. Total liabilities of $49 billion, down from $50 billion. The biggest liability is long-term debt of $37 billion. Here's a breakdown of the long-term debt. It's 2 pages. Here's debt they took on in 2022, but it has an expiration date of 2029, 2032, and 2037. And here's the interest rate and the principal. So the interest rate isn't too low, 4 to 5%. Here's debt they took on in 2021. That's a lot lower interest rate, 2 to 4%, $10 billion. And if you keep scrolling down, they summarize it. So $40.8 billion of debt outstanding, $1.6 billion is due within 12 months, $37.6 billion is due beyond 12 months. Here's the 1608, that's in current liabilities, because current liabilities are debt that's due within 12 months. Long-term liabilities is debt due beyond 12 months. If you take their assets, $72.8 billion, minus their liabilities of $48.8 billion, you get their equity, $23.9 billion. Equity is the value of the company according to the balance sheet. They raised $21 billion from selling their business, from selling common stock. They profited $2.7 billion from running their business. Retained earnings is the sum of all their prior net incomes, minus the sum of the dividends they paid out. Here's their statement of cash flows. Operating cash flow is the first section on statement of cash flows. That's how much cash the company generates from its operational business, $18 billion. Net income is on the income statement. That's the company's accounting profit. It's not actual cash. Cash flow from operations is net income converted to cash because you add or subtract the non-cash items on the income statement. In their investing section, they spent $450 million of PP&E and $53 million of acquisitions. In their financing section, they had a cash outflow of $16 billion. They paid down $400 million of debt, $7.6 billion of dividends, and they bought back $5.8 billion of common stock. They also paid $1.9 billion of taxes on stock they gave to their employees. Here's the company's stock price since they started trading in 2009. So it looks like they had a pretty steady growth from 2009 up through about 2021. Then they really shot up since then. These bars at the bottom are the trading volume. Lots of trading volume certain months. Look at this month, that's their biggest month. 174 million shares traded that month. Trading volume could indicate lots of interest in the stock, although it was a red month, so the stock went down. There were more bears than bulls. Look at May 2023. This is a green candlestick. So it opened down here at 626 and it closed the month at 808. And look at the wick. It got up to 921. And there was lots of trading volume also that month. 70 million shares. That would have been a great month to get into the stock, especially if you got it down here. It's just hard to get a good entry point for these stocks. It seems like just buy it, don't wait, because if you wait, it just keeps going up. There has been a pullback for several years. Here's their shares outstanding since 2017. It's been pretty flat. It's actually up a little bit. 409 million. They did decrease in 2019 to 398 million, but then it's gone up since then. It did go down from 22 to 23. Usually when a company has a big acquisition, they may dilute shareholders. And of course, they take on debt. Look how much their market cap has grown. Huge growth from 2017 to 2020. It did drop into 2021. Then these big leaps the next 2 years. It's just crazy how much the market moves, especially for some of these semiconductor stocks. Let's take a look at the stock on Simply Wall Street. Its last price at 1,070, 490 billion market cap, down 3% in the past week, up 86% in the past year, which is really good, but Nvidia's up like 230% in the past year. Let's see what they say about the company. Broadcom designs, develops, and supplies semiconductor devices. They operate in 2 segments, semiconductor solutions and infrastructure software. They were founded in 1961, headquartered in Palo Alto, California. Simply Wall Street has them undervalued. Their valuation is 12.11, 11% undervalued. 31 analysts have this stock at 11.30. Everyone's saying it's undervalued except me. Their revenue in 2013 was only 2.3 billion. And it looks like it goes up just about every single year. And pretty good growth numbers, that is. Up to 16 billion in 2017, 23 billion in 2020, 36 billion currently. And the forecast for 2024 is 50 billion, 2025, 55 billion, 60 billion in 2026. Do you think it'll hit these numbers? They didn't have any debt in 2013, then they added some in 2014, and it seems like every year they add a bunch of debt. It peaked at 46 billion in 2020, it's down to 39 billion. And their equity is lower than their debt. So that's why they have the worst debt to equity ratio out of all the semiconductor companies. This green line is their cash. They do keep a good amount of cash on their balance sheet, but a lot less than their debt. 14 billion of cash, 39 billion of debt. This blue line is their dividend yield. They didn't pay a dividend back in 2015. They started paying a dividend. Its highest yield was 5.2% in 2020. The stock price came down, so the yield went up. The current yield is 2%. The forecast is 2.4% by 2026. These vertical rectangles are their quarterly dividend payments. So back in 2014, it was 27 cents. And it seems like they raise it a little each year. They're up to $5.25 currently. And if you annualize that, it's $21 for the year. 525 times 4 is 21. Hock Tan is a CEO, annual salary 1.2 million, compensation a whopping 61 million. His tenure as CEO is 18 years. Lots of insider buying and selling, mostly selling. Here's Hock Tan, 20,000 shares. Here's a couple of buys sprinkled in, but mostly selling. About 100,000 shares have been sold, 12,000 shares have been purchased. 73% of the company is held by institutions, 26% by the general public, and 1% by insiders. Their biggest shareholder is the LA firm, Capital Research and Management. They own 15% of the stock. This company has 2.6 trillion of assets under management. They own 73 billion of this company. Vanguard, 8.6%. Vanguard's assets under management is 7.7 trillion. Lots of big firms own this company: BNY Mellon, Morgan Stanley, JP Morgan, T. Rowe Price, Eaton Vance. Their employee count has gone up over the years, 4,800 in 2013, it's currently 20,000. And the ticker trades on the London Stock Exchange, Deutsche Börse, Mexican Bolsa, Wiener Bourse, Nasdaq, EuroTLX, Xetra, BATS Europe, Sao Paulo Bolsa, and Buenos Aires. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.